Alrighty, folks. Are you a gambling man or woman? Are you betting that interest rates will be coming down? If so, a 6-month DSCR or full doc loan might be right for you because you could get that today at Convoy Home Loans for sub 6%. All right, guys, tell us what it is, what's going on, because this might be something that people are going after.
Yeah, essentially it's what you said, exactly what you said.
Yay! I got it right.
It's a 30-year loan, but it's a 6-month adjustable, adjusting every 6 months. Mike hates it. I know
Yeah,
it's a
I don't like it. It just goes against every. But hey, again, if you're I mean, if like you're here, like rates got to go down. That's just what you believe. Okay, that's
yeah.
just yeah.
So it's a 6-month arm. We've talked about it previously on the channel, and it lost a little bit of flame because rates were kind of on the similar par level, and nobody really wanted the 6 months because everyone's
Yeah.
thinking the rates were going to go up. So now everyone's not thinking the rates are going to go up. So it's like, now we're switching back and forth, but it's been really popular with our clients to be able to do DSCR loans at like 5.625 on a 6-month arm, right? And it's fixed for 6 months at a time, but it's a 30-year loan. And
There's
obviously,
probably a cap. I'm gonna
right,
guess.
yeah, so it's a hybrid, right? So it's a 215 cap, which means the first time it adjusts, the maximum it can adjust is 2%.
Okay.
And then every 6 months after, the maximum it can adjust is 1%, up to a
Okay.
cap of 5% from the 5.6. So, worst case scenario, if you are a betting gambling man and you're like, well, rates are going to be down in 6 months, then you just rode out the wave of 6 months to a year at 5.6 when everyone else is at 7 or above,
Yeah.
right?
Okay.
Or if worst case scenario, rates do just start jumping up, the worst situation possible would be in 6 months or on month 7 on the first adjustment, you're at 7.6, which is
Okay.
kind of like similar to the market right now. And
Yeah.
then worst case scenario, the month 13, you're at 8.6, which at that
Okay.
point would probably refi out anyways into like, okay, well, I give up. I give up.
I was wrong.
Yeah. Yeah. So the opportunity is there for purchase, cash out, rate and term,
Okay.
all of that at that lower DSCR rate.
Now,
And
could it go the other way? Let's say rates collapse. Could it go down? Is there a floor, or is 5.6 the
that
floor?
5.6 is the floor. But I'm
Okay.
assuming like if we, right until we were getting into this, we actually wrote a bunch of loans at like 3.2,
Hmm.
2.9, like right before the jump up. So
Yeah.
those ones I'm starting to see adjust up, but that's still below market.
Yeah.
So a lot of clients are like, well, they were like, whatever. 3.2, they started at 3.2, now they're at like,
5.2.
at 5.2. They're like, that's still way below the market. So they're like, it's all right,
Yeah.
doesn't matter. Yeah.
There you go. There you go. Well, again, this might be again this could be for long term buy and hold, but it might make a lot of sense for kind of value add or flips. Is that fair, or is it not really doable for flips for some reason?
No, I mean it definitely is, because a lot of people that get flips aren't getting like your typical 1-2 year bridge, right? Some people
Right.
actually get 30-year fixed DSCR loan for a flip,
Yeah.
right? And this one, I mean, if you are like Jonathan just went over, going to have a 12-month kind of time frame, I
Right.
mean, if you run the numbers, 5.6 for 6 months, 7.6 for the next six, your average is going to be 6.6.
Right.
You go with the DSCR, maybe you're at 7.25, so you put an extra, a couple bucks in your pocket, but you get it done in month 7 or 8, which a lot of people are doing on flips, then
Yeah.
you really beat, what you could have gotten. So we're
Is
seeing a
there
lot of that
a
too. Interesting.
yes? Is there probably a prepay, or could you buy that down, or
No prepay on this one, which is what's crazy.
really no
Yeah.
prepay? Oh, now it makes
Yeah.
sense if you're a flipper,
Yeah.
right? You get into a flip.
It has to be
Yeah.
turnkey though. You can't like the appraiser still has to happen. So like if you're buying it on a flip, you can't necessarily buy it if it's not in ready position to move in. It has to be in a good condition.
Okay. So it could be a total junker.
It can't be a
Can't
junker.
be a total junker.
Okay,
Yeah.
that's good
Has
to
to
know.
be
But
move in ready at least to pass an appraisal. And then
okay,
you
good.
can, if you wanted to do value add and flip it, you can.
Okay.
And obviously if it's a decent enough property, clients are still going to find a lot of success because it's way
Oh
cheaper
yeah.
hard money or something.
Oh, for sure. That's a pretty good option. What other programs are going on? What other things you guys offering? Get creative on anything exciting you want to announce?
Not anything exciting, but we probably in the next month we will be, and you guys will
I
hear it
know you're
first.
working on something.
Yeah, we're trying. When we rolled out last, or maybe 3 weeks ago, the second mortgage DSCR, that is still in negotiations because it's just basically impossible unless you're at like 50% LTV. I'd say, Jonathan, the one thing I've kind of noticed just from the company as a whole, though, we're doing a lot more bank statement loans for investment properties than DSCRs, especially in our area for Southern California, because like when you buy one that's even move-in ready, like we spoke about, the market rents aren't going to be cash flow positive here.
Right.
It's not going to be cash flow until our client gets in there and turns it into a short-term or medium term, or turns it into something that at least would be cash flow positive. So they're going the bank statement route right now.
Gotcha. Remind people what a bank statement loan is versus DSCR.
So what
Go
this
ahead.
is, it's basically using somebody's 12 months, 6 months, could be as low as 3 months. Business bank statements, you got to be self-employed, which a lot of investors surprisingly are. And you use the deposits on those bank statements as the means of qualifying, and that's what we use as your like monthly income, rather than like, hey, let me see your tax returns, your gross was 3 mil but you lost 100K, like, sorry, we can't.
Very creative. Yeah, exactly.
Yeah.
Aggressive tax accounting. Yes.
Yeah.
Understood. Very cool. Well, Jonathan, anything you want to add around here?
Yeah, I mean, we've been doing a lot in terms of investment properties, but also primaries right now, just to give people an idea of like where it might be at. I think I just put a couple multi-million-dollar LA single families in at like, it was 20% down, $2.5 million loan. And it went at it's 6.7 with with no points. So it's kind of like a situation where, and if it was primary, it would have been like 6.5 or 6.6. So it's like, it's not a bad option right now. Especially like for someone like myself or Dustin, who like, we would rather do the higher rate because we know we're going to refi anyways on a bank statement loan than pay more in taxes. Right. Like a lot of investors and a lot of wealthy people will be in the same page. I mean, it's not a bad option right now versus conventional. So, because conventional, anyways, on a primary, you're looking at 5.8 to 6.25. Like you're looking, it's the same range, a similar range. So it's like, it's allowing a lot more investments to happen. You can go interest only on it too, so that helps as well, to keep the payments lower. But yeah, that's kind of been our trend that we've been seeing.
Very cool. Well, folks, if you want to know what's going on, how these guys can help you, go to the convoyhomeloans.com and let them know you came from ORAT. So what happens is you get one of these two guys, not those other people. You get one of these two guys. Thank you so much.
Thank you.